2023 has felt like a year of contradictions. On the one hand, you have some warning signs flashing in the economy. The Federal Reserve has been raising interest rates. Inflation remains above the Fed's target. We've had some instability in the banking sector as we've seen a few banks fail. Commercial real estate might be on troubled ground, and bankruptcies are clocking in at some of their highest rates in over a decade. Oh, also the yield curve has been inverted for some time now. Despite all of that, the stock market has been on a strong run for the first 6 months of the year, posting plus 15% year to date at the time of making this video. To many people, this might seem maddening. How can the economy seem to be in trouble, yet the stock market is going so strong? Well, it's a common misconception to assume that the two move perfectly in lockstep with one another. The stock market can fluctuate pretty wildly, losing or gaining multiple percentage points in a single day of trading. Yet in most cases, those wild fluctuations don't mean you wake up the next morning without a job. Today, I want to talk about the relationship between Wall Street and Main Street. How do they relate to one another, and how do they differ? Imagine a person going on a hike with their dog off the leash. Both the hiker and the dog are moving in the same direction on the hiking trail. When looking at the hiker, her movement and stride are fairly steady and straightforward. She has a pretty predictable path with few deviations that she follows to navigate and travel along the trail. This is sort of like an economic trend. Now, when you observe the dog, it is moving around like a lunatic. It goes this direction to check out an animal scent and moves in another direction to pee on a tree before going off to a new path through the trees to bark at a deer in the woods. In this analogy, the dog is the stock market and the hiker is the economy. They both roughly end up in the same place and they are kind of walking in the same direction most of the time, but there's a lot less deviation and volatility in how the hiker walks than how the dog walks. When you consider the stock market as a dog, barking, zooming about, chasing squirrels, it's a good way to see in your own analysis that the greater economy is probably not as erratic and volatile as the stock market on any given day. When we look at the S&P 500 plotted against real GDP, we see that there is some divergence in any given year, but the overall trend is moving in the same direction. Look at 2009, for example. Real GDP was down negative 2.5%, and the S&P was up 26% that year. Using a couple more recent examples, look at 2020, real GDP down 2.8%, and the S&P was up 16%. Then 2 years later, in 2022, real GDP growth 2%, S&P 500 negative 19.5%. So again, they tend to move together in the long run when we look at the trend overall, but in any given calendar year, they don't have to move together at all. We as humans tend to suffer from recency bias. This makes us perceive these kind of incongruous facts as if it is a logical impossibility, when in reality, history shows us that this happens within the relationship between Wall Street and Main Street. If your recency bias is telling you that you are enjoying this video, then please give it a like and consider subscribing to the channel if you want to see more economic and business content in the future. Okay, so they don't move together all the time, but does the stock market tell us what is going to happen in the economy? The answer is disappointing, sometimes. I feel like there's a reason economists get made fun of. We tend to say things like on the one hand and on the other hand, and we can't really give a straight answer. Anyway, getting back to my point, stocks can be seen as a leading indicator for the economy. A company or industry sector may be showing troubling signs, and as a result, their stock prices take a hit. Well, there can be a lag between the vanishing stock values and the underlying reasons for those results to pop up in the economy, as decreased economic value, job layoffs, things like that. But the stock market can often get it wrong, misunderstanding the situation the company or the sector is in. Stock prices can overreact to the situation at hand. Look at 1987. There was a 23% crash in the S&P 500 on one single day. The economy didn't even stutter. But we also have examples where the stock market is accurate. Look at the dot-com bubble in 2000. The economy was really strong from 1982 all the way up to 2000. Then all of a sudden, the stock market course corrected on the tech stocks that were wildly overvalued for what they actually had as a fundamental business. The market was too hot, and the dot-com stocks crashed as a result. The effects were not contained to the tech stocks alone, however, as the losses spread to the other stock sectors as well. Within a year, we were in a fairly long recession. So we can see that the market gives us reliable and unreliable signals on what is going to happen in the economy. But being able to tell in real time if it's reliable or not is very difficult, if not impossible, to do. When you hear stock market forecasts based on how the economy is doing, or even worse, how they think it will be doing, keep in mind that there are a bunch of other variables that affect stock prices and the market on a daily, monthly, and yearly basis. This includes everything from Federal Reserve policies, interest rates, fiscal spending, tax rates, legislative changes, natural disasters, energy prices, international markets, geopolitics, and so on. Expectations are also one of the most important components of stock prices, as we expect certain elements in our economy such as the inflation rates or interest rates. Those expectations get baked into the stock market pricing. You might hear the phrase, everything is priced in. Well, that's not exactly true, but that is what they're talking about here, when those expectations are already assumed within the stock price. Returning to our analogy for a moment, a lot of the stock participants expect the Federal Reserve to be watching the dog, and to some extent they certainly are, but in reality they're watching the hiker much more closely. That is what they're concerned with. So stock market volatility isn't likely to get a reaction from the Federal Reserve that sets monetary policy unless it's an extreme, prolonged event. So here's something to consider. If I gave you next year's economic data, what would you do with it? You wouldn't have any certainty on what's going to happen in the stock market. You could have any economic outcome and not know if the stock market would have a good, bad, or neutral reaction to that economic news. There are too many other things that can happen that will affect stock prices to make an accurate prediction based on economic data alone. There's no magic formula that will spell out what's going to happen in the stock market for you. If there were a formula, we'd all be reliably rich and know exactly how to invest. And that's just not the case. If you like this video, consider checking out my video on the inverted yield curve and how it is used to predict recessions. Thanks for watching, and I'll see you in the next video.